Okay, traders. Hey, it's Kurt Frankenberg coming at you live from Palmer Lake, Colorado. And you are watching this video because you're one of the chosen few, one of the special ones that found out how to get it and jumped through the hoops. And anyway, I want to thank you. I want to thank you for requesting a special video, and I think you're going to like it. Okay? If you have questions, don't hesitate to mail me at support@radioactivetrading.com. Well, let's dive in, all right? This special secret bonus video is the one in which I guaranteed another riskless spread trade setup. Okay, now if you've been to one of the webinars, which is how you got the invitation for this video anyway, you have likely seen one of my riskless trade setups. Okay, riskless spread trades. And this particular one is going to include income method number 5. It's a spread trade that's done at a credit. This spread, done in the way that I show it, okay, done in the correct context, has zero risk. Yes, it can be done in an IRA. Yes, you can qualify to do it. If you are able to sell covered calls in your account, you can do this. The money net can end up paying you twice, and there's not a lot of qualification for it. Okay, if you can qualify to do covered calls, you can do this. It pays you to open, and it may pay you again when you close it. And it's possible that it would be at a higher premium than a covered call trade. So here's the deal. You're sitting on some stock, and if you're doing it my way, that stock is protected by a put option. You'd like to pick up some premium, but you don't want to have the problems that go with a covered call. For example, have you ever sold a covered call and then your stock went up and you said, oh, I should have waited a little longer, then I get a little more premium? Well, this actually kind of solves that problem. Another thing too is if that stock goes really high, you cap your upside. Not with this special credit spread. You would cap your upside with a plain vanilla covered call, but not with this spread trade. Okay? All right. I call it income method number 5, and it's nicknamed the money net. Let's say that Lulu is trading at 88.15. Lululemon Athletics, the yoga apparel company, I was trading this a few months ago, and this is how we set her up. Okay? I sold to open two $90 calls at $2.90 a piece, and used some of the proceeds to buy an April $85 call. Okay, so let's take a look at that. It's $2.90 times 2 equals $5.80 total premium in, and the premium paid out was $5.60. So this 20-cent credit pays my commissions. In Options Express, this is one commission. Now, your broker might charge differently. You may have to pay 2 commissions for both legs of this spread trade. But anyway, it should cover your commissions and even leave you a little bit of extra premium. This spread trade is called a ratio call spread, and normally it has infinite risk. The way you would do it is to sell to open 2 calls and buy 1 call at different strike prices and do it at a net credit. Now, unfortunately, there's unlimited risk associated with doing a ratio call spread if you do it the regular way. We're going to do it differently. Okay? Now, real quick, we're going to go and magnify and take a look at this. You get paid on the front end. You see there where the line is flat? That is a credit. It's above the break-even line. That is a credit. And if the stock closes below $85 in this case, we keep the credit. As the stock approaches $90, well, those $90 calls are going to expire worthless if the stock trades below 90. But if it trades right at 90, the $85 call is going to be worth something, isn't it? It's going to be worth $5. So here at the apex, that's how much you could possibly make. Okay? So it's very possible that if your stock ends up anywhere in this zone, you're going to pick up more credit than when you began. Okay? Now, the problem is not this big area. It's if the stock trades past it. If the stock trades way high, well, now we're in trouble normally with a ratio call spread because we have 1 long call and 2 short. That means that one of those calls is naked. Okay? Wait a minute, you might be asking. Didn't you say that this was going to be a riskless spread trade? Well, yeah, I did. And it is. but it's because of the context. Remember, you shouldn't be naked. You shouldn't be selling calls and not have it covered with something, okay? But what we're going to do is do this in the context of owning 200 shares of the stock or more. Then that unlimited upside risk goes away because the upside risk is due to the fact that the stock may go to the moon and you may be obligated to deliver it at that $90 call strike. That unlimited upside risk goes away if you have the stock on hand. Okay? And remember, we talked about doing this in the context of owning a married put position with 200 shares. Okay? It's a risk-free trade. If you own the stock and you've sold no more calls than you have 100 share lots, and you did it in such a way to take a credit, you've got to make sure that you do this, okay? You've got to take a credit by buying the 1 and selling the 2, or buying the 2 and selling the 4, okay? You take a credit, well then there's no risk at all. There's no reason that you shouldn't do it. In the example that I showed here with Lululemon, the $90 calls were bidding at $290, and where the stock ended up, it ended up on expiration Friday higher than 93. Now, if I had sold a covered call, I might feel like a chump because if I want to keep the stock, now I've got to pay more to keep it than I received in terms of a credit. Does that make sense? Okay. But that's not how it worked out for me. You see, if I had allowed it to be assigned, here's how it would have gone down. Okay. I would have only got $2.90 with a plain vanilla covered call, but the money net catches extra premium. It's as though I sold the $90 call at $5.20. Here's why. I bought 185 and sold 290s. One short call is sold against the stock, and the other short call is sold against the long call. Okay? Now, think about it. If I had only sold a $90 call, I would keep my $2.90, and then the stock would get called away from me at 90. All right, and so that's all I could make with the plain vanilla covered call. Okay, but the way that this was set up, I get to keep my 20 cents plus get $90 for selling the stock and $5 extra. Well, where's the $5 extra come from? It comes from the money net. You see, we sold 2 calls and bought 1. If one of those calls gets exercised against me and 100 shares of stock are called away, well, what I've got left is an obligation to deliver another 100 shares at 90, but I also have the right to buy 100 shares at 85. In the middle of the night, what happens is my broker buys stock at $85 and sells it at 90, doing what's called automatic exercise or automatic assignment. Okay, so I keep my 20 cents premium, and then I also keep this extra $5 that gets caught. Now, $5.20 premium versus $2.90 premium for a plain vanilla covered call sounds really good to me. Does it sound good to you? All right, so after midnight, that's what could happen. However, that's not what I did. Take a look at this chart. After bulletproofing Lulu using income method number 4, I then put on income method number 5, the money net, and the chart turned into this. We've got that spot from $85 to $90 kind of accelerating. All right, if the stock closes in that zone, it accelerates. What's happened is I've actually been paid to take a small position in perhaps owning the stock. What that boils down to is something that I can't explain in this one video. It's a management technique. Rather than allowing it to get called away, what I did was manage the money net in order to keep my stock and get paid to do it. Remember I told you you could collect a premium on the front end and then perhaps collect a premium again later. It's exactly what I did. And we're going to give you another bonus. Okay, if you want to see how that was done, I've shown you the risk-free spread trade right now. I'll show you the management technique if you write to me at Radioactive Trading Headquarters, support@radioactivetrading.com, and I think you're going to really enjoy it. Now, this is Kurt Frankenberg. I'm signing off. I want to remind everybody that everything that I showed you in this video is a technique. It's not a recommendation or an encouragement for you to go out and start willy-nilly selling calls in your account. Okay? Make sure that you really understand this video. You're going to want to watch it more than once, and it'd be really a good idea for you to buy the blueprint and know the 3 different management techniques that you could use with this particular spread trade. Okay, this is Kurt Frankenberg, RadioactiveTrading.com. I'm signing off. Get the blueprint and get the bonus video. Write to me at support@radioactivetrading.com. Thanks. Happy trading.